Perfect. Thanks a lot, Matthias, and thanks for the introduction. It was very interesting to listen to Tony's presentation, so I think I don't need to explain you again why it's important to invest in fixed income alternatives, given the current environment that we have in the profitability and yields that we have in the fixed income, in the traditional fixed income areas. Today, I'm gonna talk about our Global Lending Opportunities Fund in the next 10 minutes or so. It's a fund that is basically focusing on a diversified exposure to direct lending strategies, only senior secured lending. We only do lending against strong levels of protection, and the target return in the fund is 8%, and investors, they can basically enjoy monthly liquidity where they can get in and out relatively easy. But before I talk about the fund, let me just give you a very quick overview of what Katch Investment Group is. We are a pretty global company, well, at least we are in the Americas and in Europe. So our main office is in London. Then we have an office in Panama. We have an office in Brazil, in Sao Paulo, and finally we have an office in Zurich, in Switzerland. Overall, we have around 30 employees in our group, but the group was founded by the three partners that you can see here on the slide. So we have Stéphane Prigent, who is our CEO, Laurent Jaume, who is our chairman and COO, and finally myself, I'm the CIO of the group. We all gather quite some experience in asset management and wealth management. Stéphane, he's ex-State Street, ex-Lehman Brothers. Laurent was the portfolio manager of a hedge fund portfolio. He was also the CIO of a big insurance group. And finally, I started my career in Credit Suisse, where I was an analyst, advisor, and portfolio manager before I became the CIO of a multifamily office. Right now, we still have some advisory mandates that we got from different multifamily offices, but our main activity is the management of our different investment funds. They are all dedicated to alternatives and primarily private debt. The main vehicle that we are currently managing is an umbrella fund that is Katch Fund Solutions. As you can see, it's a SICAV RIV based in Luxembourg. For us, it was actually pretty important to choose Luxembourg as a jurisdiction. It's obviously only for non-US investors, just to be clear on that. Luxembourg stands for investor protection. You have very strong institutions. As in the case for Tony, obviously, we have an independent administrator, custodian bank. We have an AIFM that is also responsible for portfolio management and risk management and so on. And finally, we have an audit, which in our case is KPMG. So below this umbrella that we have in Luxembourg, we currently have 4 different sub-funds. So we have the Katch Global Lending Opportunities Fund, which is the one that I'm going to explain a bit more in detail in the next minutes. But we also have a real estate lending fund that only does investing in UK bridge loans. We have a factoring fund that does factoring in Brazil. And finally, we have a litigation finance fund that is mainly funding legal claims against financial institutions in the UK. As you can see on the chart, most of the funds, they have monthly liquidity. So it's relatively easy for investors to get in and out if they wish. So I'm focused on the first one, on the Global Lending Opportunities Fund, where we have around 100 million assets under management right now. As I said at the beginning, the fund is mainly doing senior secured lending, short-term lending, which is very important, niche areas where we can get strong protection, but also niche areas where we see that there is not a lot of competition from traditional lenders, such as banks. This has been a very important trend since the great financial crisis, that you have many interesting niche areas where the banks have been retreating. And this is also why you get quite some interesting returns, even with a strong protection that you can get. So out of the 4 main strategies that we have in the fund right now, in the Global Lending Opportunities Fund, are factoring, trade finance, opportunistic direct loans, so credit opportunities, and finally, a bridge lending. It's important also to highlight that in the whole portfolio that we currently have, 2/3 of the whole portfolio were sourced completely in-house, so our own origination. And we target to improve this ratio even to 80% own origination, which is one of the competitive advantages that we have. So I cannot basically give you all the details of all the strategies, but I just wanted to give you some example of strategies that we are doing. For example, in bridge lending or in bridge financing, our biggest exposure is to the UK. The UK bridge lending area, we manage it in-house through our London office. We have currently 4 people that are dedicated to this strategy. We do mainly short-term lending against residential properties around London, which we see as a very attractive area, because the ones of you that know the UK, you know that there is a significant housing deficit, and we have seen that especially low and middle income house prices, they have remained extremely stable even after Brexit and during COVID-19. It's important we don't invest in real estate. We do lending against real estate. So if we lend against real estate, we do it on a quite a short time horizon. Typically, the duration is 6 to 12 months when we do a real estate. In some cases, it can be a bit longer, but on average, right now, we have around 8-month duration in the portfolio. And more importantly, we have a loan-to-value ratio of only 59%. So this is the very crucial point, and it's mainly backed by a first lien charge on a property. What does it mean? That if we have a recent valuation of a property of, let's say, £1 million, we would give on average a loan of 590,000, which basically means that even if the property decreased by 40%, you would still be fully covered. So, I mean, it's very interesting because the returns that you can get, as you can see, are pretty attractive, and at the same time, you have quite an interesting safety cushion. So one can say it's a pretty safe strategy. And if you compare it to rates or yields that you currently get in the traditional real estate sector, if you do the equity, even with leverage, sometimes you have to take much more risk in order to get similar returns compared to short-term lending. A second example that I want to highlight is in the factoring area. In the factoring area, as you saw on the chart with the regional distribution of our different offices, we have a pretty big office in Sao Paulo, where we currently have 10 people working for Katch, from where we do the factoring operations in Brazil. It's a very good example, because actually we looked at factoring opportunities in many countries and regions, including the US, the UK, Switzerland, the rest of Europe, the rest of Latin America, and so on. And we really strongly believe that Brazil is the best country to do factoring. You get basically risk-adjusted returns that are just superior compared to other countries. There are different reasons for that. First of all, I think it's very important to mention that in Brazil, the factoring activity is fully regulated. So in order to be able to do factoring in Brazil, you need to have a local fund structure, which is actually pretty similar to a Luxembourg fund structure. You need to have an independent administrator, risk manager, audit, custodian bank, and so on. It's fully regulated by the CVM, the Brazilian authorities, the Brazilian regulator. And also in Brazil, every invoice has a unique tax ID, so you can actually check at the homepage of the tax authorities in Brazil whether the invoice is real and valid, which basically means that in Brazil, compared to other countries, the risk of having problems or having fraud is much lower. Maybe for those of you that are not that familiar with the factoring strategy, I can give you a very brief introduction. So factoring means you buy an invoice at a discount. Typically, you have a duration of 3 months. So if you manage a portfolio, the average duration of the portfolio is typically 45 days. So it's a very liquid strategy. And the good thing about factoring, and especially in Brazil, is it is relatively easy to get a confirmation of the buyer of the obligor, which is the one that pays you directly into an escrow account if you are the factoring company. Just to give you an example to make it a bit clearer, if you, for example, buy an invoice from a milk producer that sells its products to Walmart, basically the small milk producer would be the one that defines the interest rates that you get. So the interest rates are pretty attractive, and especially in Brazil, because in Brazil the lending environment is dominated by a couple of banks that are pretty abusive. So in Brazil you still have lending rates of 25-30%, while the central bank rate is now at 2%. So in factoring you can get very interesting returns. But the good thing is, if you buy an invoice from a small producer and the one that pays you it's a large company or a multinational company like Walmart that will buy the milk from a milk producer, you can basically transfer the credit risk from a small company to a large company that pays you afterwards and still get a very attractive return. So maybe just another example of strategies that we manage is in the credit opportunities element. So it's more like opportunistic lending. One example that we actually just did very recently, we provided a loan to a fund, a Luxembourg fund that had a very imminent cash need. We were able to get the full fund as a collateral, a full pledge on all the assets that the fund has, and the assets they are worth about 10 times the loan size, and at the same time the interest rate that we got was extremely high in the double digits, and this is really a very good example why it's so attractive to be in the short-term lending area, because if you are in the short-term lending area, especially if you lend for borrowers that have a lot of assets but a very strong need for cash in the very short term, for them it's extremely tough to get the lending on such a short notice. So you basically need to have a very quick execution in terms of your strategy. So I just wanted to show you the diversification that we have right now in the portfolio. So you can see that we are diversified in terms of strategy and diversified in terms of different regions. So that's important for us. And also, as we have monthly liquidity in the fund, it's important to show to investors the liquidity profile that we update on a monthly basis. So without going too much into details, you can see that in 6 months, we can basically liquidate, or we have a maturity of 70% of the portfolio. So it's extremely liquid. We saw that our fund, as I said, has a target return of 8%. So you can see in the history, the return have been extremely stable, non-correlated to traditional asset classes. 2018 was 8%, 2019 8%. This year, because of we had a bit more cash in the portfolio because we were a bit more cautious in terms of the liquidity planning during the COVID crisis. Also, we had some provisioning from March to June, but now we believe that the returns are going to pick up again to the average of 0.6, 0.7% on a monthly basis. So we are very happy with the 8% target return. Investors that wish to have a constant cash flow as a fixed income alternative, they can also choose a share class that has distribution, a dividend, and the dividend will be 6% in US dollars that can be paid out quarterly. We also have a Euro share class or Euro share classes where we have a target return of 7%, and the dividend would also be 6% paid out quarterly. So with this, I can basically give it back to Matthias. Thanks.